Good evening. Welcome to the live evening show of our Facebook, Martin T.F. Wong. And I hope I find you good and healthy, and thank you for coming. And also thank you for those of you who's been sharing this video in your timeline. We really appreciate that. And tonight we want to start off and kick off with this month of June, which is almost coming to the second half of the year, with a brand new beginner's guide. That's right. Through our feedback we've been receiving, we've been getting a lot of references to beginners, making things very simple. And that's why we are here tonight. And of course, for those of you who are listening, and if you have friends and colleagues who can benefit from this beginner's guide, how to profit from the upcoming market recovery, definitely this is something new. And also stay right to the end, because I will be also talking about some stocks that you can use it, plus a very good offer for you. That's right, something that you can make use of the activity that we do in investing and trading. I do know the market is not as rosy, but let's get down to what we have offer for you tonight. Thank you again, and thank you for sharing in this timeline. Tonight the talk is about market recovery. We know where the market is right now, and if you have seen before, the Russian and Ukraine war, the fallout from inflation, but all that will be explained in this tonight's beginner guide. So make sure you stay right to the end here. Now, of course, a lot of presentations said here are for educational purposes, and some of the information we have here are for info entertainment in here. Of course, don't forget to subscribe to our YouTube channel, as this video will be archived there and you can re-watch it again and again. So don't forget to smash that subscribe button in here. Now, of course, what we've been saying is the continuing of the series that we have for you for the month of May. So this is a calendar right in front in here. So don't miss me out on every Wednesday night, a very educational beginner's guide to get you stay ahead with the competition. Beginning today, 1st of June, of course, those titles in here, very interesting and very educational in here. Intraday trading plan, growth stocks, all that you need to put you in par with the professional. Of course, tonight where we are talking about in here, and the dilemma that most of us would have is that you are trying to make money in the stock market. Now, that's not only currently at this market return, but I'm talking about generally over time. Does this apply to you, right? And you do not know what you are buying, and you do not know when to buy, right? And to compound further, right, you look at every stock that come into your mind, whether you on the Facebook, whether a seafood is saying this to you, you analyze the market, you analyze the news, but guess what? This is time consuming. So if your success has always been a challenge, check us out. Check out some of the instruction that I will be sharing with you tonight. And of course, we want to make it very interesting. Now, let's use the following instruction following right now and some of the tools to analyze your stock, and it will help you very fast. And that's why we automate here. It also will tell you when and what to buy. All right, let's do a quick exercise in here for those of you who are here, and let's see this stock. Some of you know now, Inari, Unisem, and some of the related sectors. Let's do a quick test in here. Do we buy, do we hold, or do we sell? Now, of course, Inari is a technology firms that make and sell phones, computer, and car. Of course, components in here. The semiconductors that they made help computers and phone works. As more people buy phones and laptop, the semiconductor sector grow. So on this sector and some of these stocks, what would you do? Would you buy? Would you hold? And would you sell? What will be your answer? Type it into the comment in there. Let's check. Let's do this test instead. Would you buy? Would you hold, or would you sell? What will be your answer? All right. So remember, Inari are technology firms that make and sell handphone components, computers, and cars. So they are in the semiconductors. Do you buy, hold, or sell? Give me your answers on the comment there, and I want to know what are your answers. Definitely the answer is what? The answer is Buy. That's right. If you don't have it, that's the right answer. You want to be buying some more in here. Let's go on to the next test inside here. All right. Now you have Ta'an, Eno plantation, right? And these are plantation stocks. Okay, what would you do when you see some of these? Now remember, palm oil plantation develop palm oil for edible oil. Cooking oils will be traded in worldwide markets in here. And right now we have a commodity boom, right? And we see edible oil increases and palm oil prices rise. So again, these kind of sector, as you see Ta'an, Eno plantation, do you buy, do you hold, or do you sell? Now this is very important because this will basically go into your subline in how you analyze the market. Let me know on the comment in there, right? I've seen some of you already in there. What would be your interpretation here, and what will be your decision here? Do you buy, do you hold, or do you sell? What will be the answer? All right. I think the answer is fairly obvious, right? Now, please cancel those in there. I think you already know the answer. Let's go on to our next slide in here. Now, my 4 basic points, which I did talk about, whether it is the technology stock or the plantation stock, has been like this. When people save money, now remember we are talking about in beginner's guide in here, they save money in stocks, enterprise, because the returns from those other investing vehicle, may it be putting money in the saving box, are generally very low. So that's one thing. So that's why when they have to save money, and when they save money, where do they put it? They put it into the stocks and enterprises because returns from the financials of the interest rate has been very low. So the second tenet is the growth and steady increasing earnings that we see from this company. Now those two sectors we talk about, technology and plantation sector, they are growing, and you can see more and more people are using computers, more and more people are out there and they're buying foods. So this is one of the basic of investing in here, right? This is one of the basic investing here. As more people with higher money, right, means they are making money with it. That means there are more demand for goods and services. If there are more demand and goods services, that means consumption increases. As the consumption increases, price will follow, earnings will follow, but stock market will boom. So those are the 4 basic tenets that you need to understand about the stock market in here. Not that difficult, isn't it, right? So next is, yes, we all know that the stock market is down right now. We could see from the slide, money is, the stock prices is falling, and you can see here, the money is being burned. Do you feel like the money being burned or not? Type it in that inside there. All right. I'm not getting any responses from the audience who is listening in here. Are you guys still asleep or you're just watching? So do you feel that the stock market is causing you to burn money? All right. Just type it in there. Thanks a lot. All right. So give me a thumbs up if I'm still doing a good job in here, trying to get all the beginners here. Now remember, the stock market is one of the most important parts of our economy. Millions of decisions being made, jobs being created, and fortune is made. So you cannot really ignore the stock market. Every time that the stock market fall, there is always attempt by the US central banks, and they are trying to prop up this market in here. Am I correct? Right? So because of that, we must learn those simple techniques to predict the future trend, just like you see in the picture in here, like a cookie cutter, right? Making a consistent cookie every time. So we use that cookie cutter to analyze our stocks, to make that intelligent decision buying, so we will know the future trend. Now, let's say going forward, do you think in the technology sectors, on the long run, okay, on the long run, will it go down? Right, based on just what we're talking about, more and more demand, more and more consumption, and that's why it's going up. All right. Now let's talk about the definition of market down in the financial term. Now in the bear market, what we have seen before, from the peak to the bottom valley is always minus 20%. All right, from the peak to the bottom, you will see the market go down by 20%. And when the market start to recover, take note of it. The bottom valley to the peak, it will be plus 10%. So what we are saying here, if you see this falling, right, by more than 20%, then you will see, right, a bear market. That's what we are seeing. But if from the bottom up to here, right, to the peak, where it is moving right now, because we've seen the last 3 days of the US market. And our KLCI started to recover where we have plus 10%, then we are in a market recovery role. All right. So those are two distinct definitions. Now keep that and bear that in mind. Bear market is from peak to the bottom, minus 20%. The market recovery is from the bottom to the peak at plus 10%. So these are two things you should not miss out. And if you're a beginner, you know this fact, you are much better off than a lot of professionals out there. All right, now let's take a look with the market that we've seen. This is the Dow Jones Futures. You can see just on top of me here, from the January time frame, okay, January to May 2020, the peak to the valley was minus 17%. This was the minus 17%. There was many people was really complaining. So they were saying like, we are really slipping in one of the bear market condition, and it was one of the highest correction we've seen so far. So then the question is, are we close to the bottom yet? What do you think? Are we close to the bottom yet? Right now, usually when we see the last 6% in here, and then this was minus 17%, so this is where people get very frightened. But bear in mind, history always repeats itself. That's why we always want to study history, and when we study history, we are able to predict the future, because market goes up and goes down. Now, this is one of our trade VSA peak to valley, which you see a lot in here. Now pay notice to the purple peak tag. Now remember, we talk about the peak, okay, the peak to valley, okay, because market go up and market go down, market go up and market go down, market go up and market go down. So what you want to notice is that here is 14.7. That was the last recovery that we have in 2021. But notice since then we have 4.9. 6.3, 5.72, okay, 2.9, 9.17, 8.55, 8.23, 9, 4, 9.3. So what is the magic number here? Can you all tell? What did we talk about market recovery? Now type in there, what do you think is the right number that you'll be seeing? Okay, make a guess. It's not that difficult, right? The answer is 10%. So whenever the market hit 10%, all right, when the market hit 10%, that's where you will see, right, the market will start making a lot of up move, okay? And this is generally what you'll see on the news, all right? And you will see that on Bloomberg and CNBC. So this is one of the key things that we use. We call it the magic number, plus 10% from the peak, from the valley, from the bottom of the valley, which what you see right now here, right, to here. So from the peak to the valley, you can see that was a minus 13.6% in here. That is using the daily chart. Previously I was using the weekly chart, but right now we are seeing the plus 9.3%. So if tonight, generally, I possibly see the breaking above that 10%, going above the 10%, that will simply tells you the market is beginning a market recovery. So no surprises right now if you are a beginner. Why is the market recovery? It's because of due to this number. These are what we call the market dynamics, that the forces that we see in the millions of decision that is made between the decision maker, the financial, the smart money, and this is why we have those numbers out there. So keep this in mind. Now, why should you care at all? All right, now let's get down to the basic. Why should you care at all? All right. So if you look up in here, is that when you buy a share that is on a drop, on the dip, because we said before, right? The market has hit the peak and started to come back down in here. So you can buy it inexpensively. And also you take less risk because we are very close to the market bottom and the shares is worth less right now. Of course, with that, you earn slightly bigger profit because the share price is cheaper and you will get more when the stock market goes up. And It always does. If you look back in the whole history, the last 20, 30 years, it always goes up. And it's going to go up on one of the 4 basic simple economy that I talked about earlier on is what? Consumption, demands, price go up. When price go up, then you see stock go up. But of course, the Apple stock previously hit a high of $180. Microsoft hit a high of $34. Inari, being the technology sector which we talk about, still growing, hit $4. Taan at $6.80, right? So right now, the current prices for Apple is how much? If you look from the Apple shares current prices, let's go on to the Apple share current prices here, right? It is at $150, okay? So $150, let me just bring back the calculator here. So here I have the calculator. So we have 150, so it's 30 divided by $180. So it is a 16% discount, a 16% discount altogether, right? Let's take a look at the next one. All right, the next one we have is Microsoft, okay? So Microsoft is 276. 276. 276. Let me just get my calculator again. Okay, 276 and 340. So 340 minus 276, that gives you 64 divided by 340, which gives you an 18% discount. But not to forget our local share, which is Inari. You can see Inari is used to be $4 right now. And if you take that, now it's 270 divided by $4. That is almost a 33% discount, right? 33% discount. Taan, take it at $5. 5 divided by 6.8, that is a 73%. So minus 1, you're talking about a 27% discount. So that's why you are buying a stock that is very, very high on discount. And it's easy to make the money back once the market goes back up. And they always do, as I said before, on the market recovery in here. Now let's talk about Business Theory 101. Now this is important because that will simply tells you why we are able to predict the future trend in here. Now let's start off with credit. We see on the top side, money was a lot. That was way back in the 2008 when interest rates were very, very low. So we can see those prevailing interest rate conditions continue to go on. As credit become more cheap because the government is trying to simulate a lot of demands and profit, right? This is partly due to business cycle 1.1, all right? And also relevant to our time. The COVID-19 lockdown has spurred a lot of demand. So because of the demand that spurs, it causes inflation. That's what we see. If you turn to your newspaper, right, you will see your nasi lemak, right, has cost much more. Your petrol prices has cost much more, and this is also due to the supply chain. As more demand is there, the COVID-19 lockdown, you see many lockdowns which is ongoing, and also the wars that we've seen in 2022 between the Russian and Ukraine. But like it or not, this inflation is only going to be temporarily, all right, temporarily, as the US FOMC are coming in to control the inflation by raising interest rate. But at the same time, when inflation is high, you also get high employment, right? High employment because this is due to a lot of demand. Now you all know that, right? You can be seeing on newspaper in here, and the fact is it's very hard to find workers right now because many of the workers have already quit their job during the COVID-19 and they're not returning it back as soon as it is. So usually when you see a lot of employment in there, what we are seeing, right? Employment is still very low unemployment, right? We are getting a lot of jobs. That will tell you the economy is still in pretty good shape. So the market is really taking a fall, and this is due to what we just talked about, the high inflation rate, the prospect of a slower growth, and also the week before we were talking about recession. But I think all in all, the facts will justify by just understanding this business cycle 101 theory. You will understand why we see the market is likely to recover. All right. Now, one of the best person to talk in this very wide experience is Peter Lynch. Now, I have a book of this in my bookshelf in here, but I just want to talk about, he was one of the well-known Magellan fund manager, and he was an excellent money manager going back to 1977 to 1990. Yeah? And he actually retired pretty early at the age of 46, because why? He made an average of 29% annual return. Now, just compounding on 29% annual return, that's a fair bit of thing, right? So that's why sometimes when people ask me what is a good reasonable rate of return, I say if you can do 12 to 15% a year, that is very good. But no doubt the 1970s to 1990 was a period of boom that we see in US, and many of the stocks that Mr. Peter Lynch invested has done very well. He makes his investor rich by one thing: choosing the right stock. Now remember to the example that we talked about earlier. I hope you did those two examples and you have chosen the right answer. Answer is buy. Why? Technology stocks, people are consuming more. Plantation, edible oil, world consumption are going up. You know, you see there is not enough food everywhere. So more people are cooking and more demands, meaning more plantations, palm oil need to be planted. So he did this by analyzing company financials. We're talking about the annual report, not that difficult. And next thing is he will also compare the current stock price, like what we did just now, right? We were using the peak and valley, we use stock charts, and this is something that the fund managers and people like the trader like ourselves in our community use this to compare to the earnings. Okay, so I hope that you all like this format for the beginner's guide, and of course if you are the beginner, we will keep it very, very simple. Now back in the comment that Peter Lynch had back in 1984, all right, in 1984 he did make this comment here, all right. And what he says that in 1994, some event will come out of left and right field. But the market can go up, the market can go down. Market volatility is stay. Now think of it. This was back in 1984, and fast forward to today, 2022. And yet we are still seeing the same thing. So if you have been in long in the stock market like I do, you probably notice market volatility is something investor must endure, right? We cannot shy away with that, but these few simple instructions going forward, which I will share with you, will definitely help you there. But the 10 behind here is based on the same story that I talk about, the plantation stocks and also the technology stock, where corporate earnings due to growth and has been shown to growth historically at about 8% a year. So keep this in mind, 8% a year. So that's why sometimes when people tell me they want a return of 8 to 12%, it is possible, because why? It is in line with the corporate profit. So all you have to do is look for companies that has good fundamentals and invest it along the way. So a few more things to just keep in mind, right? And I'm just going to talk about in here. So let me just move myself out of the way. So he says that corporate profit will double every 9 years, right? And the stock market will double every 9 years too. So corporate profit double, stock market double. But in between, the stock market will go up and go down. And he doesn't really know where it is, which is pretty much as well. But unlike Peter Lynch, we have VSA 360, we have Pentagon Guider, and we have something that they'll share with you. We are pretty much close to the bottom in there, right? And that's why we are pretty confident to say going forward, right? The market is likely to recover. But keep that in mind. He has a wider range, a wider period in here. So what he is saying that, look, usually after 8 or 9 years, the stock market will double. And because of that, the earnings, because of stock market double, the stock will also follow it. And that's all you need to understand. Simple, isn't it? Stock market go up because of stocks profit goes up. Stock profit goes up because of earnings goes up. Earnings goes up because of consumption go up. When consumption is going up, this is also due to prices going up. You see that, right? So that's why it's important to always focus on good company that is always increasing revenue. That's all to it. All right. So that's how simple it is. So if you look further ahead and in between the years, like we can see before, going back to any market crash that we said before, right? We have this bull and market correction. You can see the purple one is those have more than the gray one that are those who have more than 10%. The purple ones are the one that in decline more than 20%. 20%. Okay, market correction is about 10%. The bear market is about 20%. So in short, if you look at it, the market always recover. Now the issue is always been many of us do not engage ourselves very well. And when you see fear in the market, what do most people do? They shy away. They don't get engaged in fear. Fear is one of the most powerful emotion that all of us have. When you see fear, what do? You don't run to fear, right? You run away with fear. So that's why for most people, this is the most rational, logical chart that you should know. Every time when the market fall, it will recover, right? Again, without fail. That is why Peter Lynch says so. And this is also due to the corporate earnings doubling every 8 to 9 years. All right. So you can see going back to the last round, you will peak minus 18% from the high, and you will need down 128 days. Okay, 128, which is the current one, dated back to the 17th of May. So that's pretty much tell it. Now let's go on to something very simple, stock pick criteria, since we want to tell you what to buy, and then later on I'll tell you when to buy. All right, so you look at what to buy, right? We have first year-on-year earnings. All right, so for beginners, you want to look for stability consistent in an upward trend. It's not that difficult. What you want to do is look for growing in earnings. Now in TradingView, all right, of course in our further training, which we will offer to you free of charge, okay, a free training that we'll be doing on, just wait to my announcement towards the end there, right? We look for these kind of company. Second, we look for company that has low PE, lower than the industry, okay, which means it is slightly cheaper lah. Let's say you have a row of houses in your neighborhood. You always want to find the house that has the lowest price, isn't it? That's why everywhere when you buy property, so you always look for the lowest price first, then only you start moving on, and it's not going to be that much of a difference. Then dividend cannot be too high, because dividend is too high, it means it sacrifices the future. Now you look at some company like Amway and BJ Toto, because of this company could not grow anymore. What they do, they use a lot of their earnings to pay dividend, and paying dividend will take away the future growth. And last but not least is little or no debt. Now recently you heard about Serber Dynamics. For those who've been following, they found out they have a lot of debt, more than 4 billion. So with this kind of debt, you have to service or pay interest. So he always advocate for companies that has little or no debt. All right, so keep this in mind. A very basic stock pick criteria that he shared with many of us already. So picking fundamental stock while investing will include looking at income, debt levels, and the kind of money they made. So you should always also check the stock price to avoid overpaying. Now, stock investing is like buying a house. So when you want to buy a house, you always look for good quality timber, making sure everything is in order in a good neighborhood, right? And don't overpay, right? So sometimes you want to pay at the reasonable price, but you don't want to pay too cheap too, because sometimes when it's too cheap, you will think the company has some issue, something like underlying the house, maybe got termites, and you don't know. So you always want to make sure that when you pay, you don't want to overpay, but you don't want to underpay too, because if you underpay, you have to be very, very suspicious of what you see over in here. Now I'm going to go on to our very famous and popular offerings, our green pentagon, which means it's an up signal, and also our red pentagon is a down signal. These are the two signals that tells you when to buy and when to sell. The timing part, which we talk about in our grand scheme of things. So this comes from the father of volume spread analysis, which is Mr. Tom Williams, the inventor of it, and he shared that the whole point about investing is really tracking the smart money. Smart money is a group of financial savvy or financial operators who has been around, and they often known themselves as syndicate. And what they do is that they will know certain insider information about a certain company. Like they will know when will the sales be better, they will know the market conditions in here better than most average investors. All right, they're better than most average investors. So that's why they are able to make more consistent money than everybody else. Would you say that Peter Lynch is an insider? Maybe, right? He seems to know a lot, but he may get access to some of those information, but whether he used those information to his benefit, that's something that we do not know. But what Tom Williams, the father of volume spreadness, had shared before, when you can follow the smart money, know what they are doing, isn't it great you follow them, right? But at the same time, looking at the company, just like looking at the house to buy. So think of this scenario. A group of what we call investor buyer, very, very savvy investor. They're looking to buy a plot of land, right? And right, this land has very good fundamentals. It's maybe near to the port, near to the sea, right? But they chose this specific spot, and you also have that capability. And it's very similar because you are following this group of very savvy investor buyers. So the same thing, what you're doing in the stock market, you're following this group of very savvy insider trading. They know all the companies, they know the CEO, they probably have a direct phone to the CEO to find out what's happening to the company in there, and they have all kinds of research that most of us don't have. So following the smart money do make sense. Do I say this makes sense? If I do, just type it in there. All right. Now, of course, right now, there are 5 of these stocks that I'm going to talk about in here. Now, Peter Lynch talked about those criteria. Remember what we talked about in here? Remember? I still remember, right? Right? Low PE, right? Reasonable price, little or no debt. Now, if you look at it, we have Dufu, Emilus, Foundback, JHM, and Signedeck. So I'm going to share with you using our combination, Pentagon Guider and a VSA 360, we are able to find out some of these benefits in here. So compared to many tools out there, they just either look at one, they don't do the company and the market condition player like, which gives us a best possible decision answer, which is today, going by the fundamental, going by the VSA, you are much better off, and it should and would give you a better returns on your investment in here. Now, of course, here is the first one, Dufu, where it satisfied the Peter Lynch simple criteria. Now, I circled up on the red in here is what we call GARP, growth at reasonable price. All right, growth at reasonable price, which means you're buying a house at a reasonable price in your GARP. Now, also at the same time, this stocks, right? This stock has GARP okay, at the same time, this stock has a rating of 5, which means it's very, very undervalued. The higher the number of the SMARTRobie rating, the more undervalued it is. So keep that in mind. So Dufu has all the criteria that you see here, being a large cap, is the 5th in the 800 and 282 product services. 3rd out of the industrial product is in the main board is Sharia. It's a growth stock, it's a long-term stock, and it is growth at a reasonable rate. Something that you should take note of. Let's look at the slide 2. Now from the slide bar, it already turned green pentagon, right? As I said before, the green pentagon allows you to buy and sell. So right now you could see in here, the market really has gone down a fair bit in here. It was about at 33% down from the peak to the valley in here. Turned green pentagon, broke through, and you can see demands are picking up. And this is something that we talk greatly in a lot of our webinars, in our YouTubes in here, something I will cover more extensively in here. But for a beginner, you want to simply follow the green pentagon, because the green pentagon signifies where the up movement of the signal, most of the time I would say, most of the time, not all the time it fails. You can see this is on the downtrend, but right now it is showing a very reasonable up signal in here. Now let's take a look at the VSA 360 as I had before in here. So once you have this VSA 360, you can lock in. Earlier on I was looking at DUFU. Okay, you can click on DUFU, search this. Okay, I have a logged in again. Look at DUFU here. There you go, DUFU is here. And also this is rated out of 5 safety. And if you look back at DUFU, right, this is what we call show me the money chart. So it simply says that if this is some of the other features, if you have bought it on 2016 and you kept it at 10,000 ringgit DUFU, today it would yield $180,000. That's a lot of return, isn't it? That is close to about 1,478% return, isn't it? Much more than it is. So here you are, another possible Peter Lynch criteria. Hopefully, who knows, it can make you the return that were all looking for. So very simple to use. This is just a quick snapshot. There are more things that we have inside in here. And of course, there's a whole list of stocks you can look at if you just type a plantation. Okay, and you can look through that. Also, you have the technology. Okay, the whole list of in here. And this is unlike other tools that you see in our market in here. Perhaps you want to use this? Say yes if you want to use this to try it out in here, right? We're going to have some information for you to use this, right? Now let's also look at the next one. Also satisfied the Peter Lynch simple criteria, but it's not undervalued stock. It is growing at the reasonable rate, is JHM. Okay, so you can see from JHM in here we have also the criteria. Currently is $1.30. Analyst is saying that it is worth 150 at 1540. Okay, so well, it is relatively not fully undervalued, as I said before, but it is growing at a reasonable rate. Just paying slightly a bit more. But one thing good about this stock is just turned green pentagon. So on the market timing side, it already turned green pentagons and is starting to move out. So if you were me, I will pick DUFU and would have gone in on the second bar after the green pentagon. But if you missed that train, you also want to take a look at JHM too. All right, JHM in here. And also technology stocks like JHM, all are moving back. You can see, right? Because the resumption of the loosening of the lockdown, resumption of the economy, we are seeing many of these stocks are looking to recover in here. Now, of course, we have done a tool for you in here. So we have find that the VSA 360 is very easy for beginner, and it's also one of the best way to learn about the basic of the stock market. Okay, so what you buy in here, we have the Robie ratings. We also have the Pentagon flow, which measure the steadiness, the bullishness of the market. Then we also have the analyst pricing in here. All that will help you to learn about the basic of the stock market. Now the other three you can do it on your own, and I'll give you a special code that you can log in and use that. Now also let's move on to the US market, which I'll talk about in here. Some of the best defensive stock right now to buy are Walmart, Abbott, Johnson & Johnson, Green Mills, and Hershey. These are defensive stocks. Again, with the market reopening in here, we have seen some of these stocks have taken a beating, especially Walmart, due to the slowing down of the retailer because of the inflation that we see in here. But you think very carefully going forward, right? People are growing, the populations are growing, and demands for day-to-day staple foods like Walmart, they are also going into online shopping grocer. These are actually very, very steady returns. So a drop in the market, right? And according to Peter Lynch, every 8 to 9 years, you'll see the corporate earnings grow by 8%. And I do believe some of these can grow more than 8%, especially one of the stocks, Hershey. As the market are reopening, you will see many more people. Hershey's, we all know, they make chocolate, isn't it, right? So it's not that different. Now, this is a chart of Walmart. It had a big drop from $150 to 100, and it used to be 155. It dropped to 120. I have not seen anything like that before. The last one that was a big drop was last year, right, where we have the lockdown. But this big drop was they missed this earnings in here. So this is actually a good opportunity for you to go in and collect the stocks. But you can wait for the green pentagon to come out. All right. So then next is the Hershey. The Hershey chocolate is another good pick. Also very good fundamental in here. Again, similar story like what we saw for the Walmart. There has a big correction in here. This big sell-off in here. But market seems to be stabilizing in here. The peak to valley was only 12%, which is extraordinary as I said before in here. But as the market now are ripe for another up move in here, this soon will turn green pentagon. Okay, so with our VSA 360, we offer this combination benefits where we'll help you to buy and sell and time your stocks. All right, being the first advantage mover for the US market and also the Malaysian market. So you can try both the fundamental and the VSA in here. For as low price as $2 per day, you can have the 12-month or the 6-month. But what we are offering today is a free 10-day trial with a coaching session in here. Now, for those of you who have not tried our VSA 360, this is a great opportunity for you to try it out in here. There's a QR code in there, or you can contact us to make an arrangement to get your free 10-day trial. No risk, no obligation whatsoever. We would not force you, hey, you must take this software in here. But I want you to give yourself a chance to test drive and validate the VSA 360. And I also hope that you can give us suggestion how to make 360 VSA a better product that will help you to make greater money, greater wealth in future. Help us, right, by doing our 10-day trials, and we will be of good gratitude to you in here. And this is something that we hope that we can work together to build a better product for the community together. As a community, together as a coach in here, right, we will help you to your new challenges and look for new opportunity, especially those of you who have not started on the US market in here. We definitely have US market on our 360 Pentagon too, right, coming soon. So all in all, in here we come to our last part of our presentation in here, and don't forget to join our Telegram chat room and stock market information, and for more of our educational updates and also tips, do feel free to share it with your friend. Now, there was a question inside there, bank stocks good to collect now? I think bank stocks should collect when it first turn green pentagon. Now, if you are buying right now, it's maybe buying a bit late lah. As I said before, it's just like people go in and buy, buy the rubber stock when it's a bit higher. So it's all going to be based on your education level and your skill level. All right. So if you feel that you're very experienced, go ahead and buy it. Right. But if you are unsure, you're just beginner out there, then it's better to follow a good combination tools like our VSA 360 with Pentagon, and also the FA methodology that was preached by Peter Lynch. That will give you an edge. All right. Now remember, more importantly, yes, market will go up, market will come down. But if you want to buy certain stock that already been up, But remember the drawdown, right? The drawdown is usually the case when the market goes through a bit of sell down. That's where diversification, psychology, right? Having the right system in here to manage your risk level too. Think about that. So all this is part and parcel of the profile and made up of a good investor that can survive, right? The difficult period, the up market and the down market. Just like pretty much what Peter Lynch has gone through in the 70s to the 90s, making an average return of 29%. If you strive to be a good investor, a good trader using both market timing and good fundamental tools, do consider our tools as it's been back tested and trial tested too by myself being a fund manager in his role in here. So if you don't have any more questions, I will stop right now tonight. And if you find our conversational, our sharing here for our beginners has been beneficial in here, don't forget to go over to our Google Play Store and also our Facebook to give us a comment on how we can improve. Our feedback is very, very important to make sure we are of good service to you and always beneficial through our sharing here. Don't forget to feedback us on our Google feedback form, and I look for you this coming Friday for our breakfast show in here. And don't forget our 10-day trial of our VSA with a special 30 minutes coaching, absolutely free, no risk to you. And with that, thank you and good night.